Hey everyone, it's time to take a ride on the L train. As always, I'm your host, Scott Rubin. I'm a licensed associate real estate broker with Compass in New York City, selling residential real estate in Manhattan and Brooklyn since 2005. Today on the podcast, I'll be having a conversation with John Pasquarello, one of the best mortgage professionals in the business. I met John about 16 years ago. He basically taught me everything about mortgages. He's a true Jedi in the business, and the level of service he provides to his clients is just tremendous. I can't say enough good things, really. We're going to learn a lot about the mortgage business. All right, so let's get started and stand clear of the closing doors, please. I'm still not sure if I really like saying that, but I'm going to do it anyway for now. All right, so my guest today is John Pasquarello. He's a mortgage professional in New York City, and I've known him since I think 2005. It's been a long time, right?
Yeah, I've known you almost the entire time I've been doing mortgages in New York City.
And you basically was in a small company in Soho, and you basically walked into the office, right? That's how we met.
I remember because it was snowing.
Oh, really?
Yeah, and I think your office said, "Wow, this guy's either crazy or very dedicated."
Right. That's funny. And yeah, I remember too, when you spoke to the office full of agents, you were the first person I met in the business. It was my first year in the business that really explained mortgages well. Like I understood everything you said. And that's something that's important to me when I'm in front of a client or a prospective client. I like to talk to them as if they don't understand my business and make everything crystal clear. So, and it's funny because now it's like, 16, 17 years later, and I'm still referring you. We've done many deals this year already.
Yeah.
I think one of the first things I wanted to focus on was the interest rates, because I don't know if everybody understands how ridiculously low the interest rates are. I don't think I can say what my rate was. I refinanced at 2.625%, which is nothing. Like my, Wall Street friends call that free money, basically.
Yeah. Rates are still really low. I think, some people are really attuned to what rates are. They jumped on refinancing when the pandemic started. Rates dropped very quickly, which is pretty common when you have a economic situation that's difficult. Rates will usually go down, which helps get things going again. And so there's a segment of the population that's always pretty attuned to what rates are doing. But then there are lots of people who aren't, and I don't think a lot of people realize that you can get a 30-year fixed mortgage for 3% or less.
Yeah, and it's interesting because when we did my property, when we refinanced my place, that was prior to any shutdown. I think we started that in late January, early February, like when we weren't really even sure that the coronavirus was going to be this big, huge thing. But you mentioned that was actually affecting rates, even though it was something that was happening mostly in China.
Right. Yeah. At the time, the beginning of 2020, right. So it was prior to the shutdown, but rates were definitely, there was economic concern, and economic concern without a calamity is usually the perfect recipe for rates. Once you get into a calamity, sometimes rates stop going down because now there's true financial fear in the markets, and there are investors, of course, that are buying all of these mortgages in many cases, or the banks themselves that are holding these mortgages, like in the case of jumbo mortgages. And so you want the best situation for rates is some economic weakness that indicates that rates won't be going up for a while, but you don't want anything too catastrophic, which is what it ended up turning into, unfortunately.
Yeah, because I always like to point this out to people because I hear people, people a little older, like my parents, saying that back in the 80s, the rates were like 14%. And I think when I got into the business, they were somewhere in the 6s, maybe 7s. I remember doing a deal at a new development, and it was 555 West 23rd, and they had some deal like, 5% down, 5% interest. And I don't remember what the other 5 was, but 5% interest was good then. And now it's, I have almost half that on my place. So
Right.
it's just good. I feel like people should know that there's something to take advantage of right now, regardless of where the prices are. It's, there's so much more buying power. Right?
Absolutely. You can stretch the dollar so much further on your purchase. And, if you think about rates, say at the time we met 6%, let's say was a 30-year fix, that was the range. And now it's literally half of that. So you're paying half the interest, which means that your payment is much lower and so much more. If you actually pull up an amortization table and you put in the loan amount and 6% and then put in 3%, just look at how much more of your money is going into your home equity every month. It's phenomenal.
It's amazing, yeah, and it's something that people hopefully are taking advantage of now. I mean, I know everybody I know in my building, and all the people I know refinanced last year. So you must have got a ton of refinances. I mean, what was 2020 like in comparison, either to now or to? I mean, it was a crazy year.
It was, as we just said. The first quarter was rates floating down, and then the second quarter was the lockdowns and sort of the most scary part of the pandemic, and that's where things got a little bit tougher, and that started to translate. It still translated into a lot of refinance activity, but once things loosened up, sort of towards the end of the summer, that's when we really saw what 2020 I think became memorable for, which was all of the people moving out to the suburbs. So many folks buying either second homes or new primary residences out in the suburban areas, leaving the city.
It's funny. I remember at one point, I don't remember when it was, like somewhere in the middle of the summer, where I had not known one person who at least admitted to getting COVID, but I knew so many people who moved out of the city. I was like, well, it's crazy how many people were leaving.
Right.
And I think that was more Manhattan than Brooklyn. Right. I mean, that's what it seemed, especially the way it affected the market. Manhattan was much more affected than Brooklyn was because I was active in both markets at the time. But yeah, I guess one of the things I wanted to ask you about is I feel like a lot of people have misconceptions about mortgages. Actually, the one thing I want to ask you, because people always ask me, can I still put down 10%? Because, after the financial crisis years ago, that became something that just wasn't possible. Like everybody was 20% or more. And then things seemed to ease up. And, I've seen a 10% loan. But
Right.
What about just people that are asking me right now, can I put down 10%? I don't know.
Yeah, so that's out there. It certainly was out there much more before the financial crisis. And it did really pull back quite a bit right after the financial crisis. But, the financial crisis is now over a decade, prior. And these products have definitely made a comeback, especially, if you're talking about what we call conforming loans. So conforming loans are loans that are eligible for delivery to Fannie and Freddie. They never got rid of their 10%. But they have products now where you can do even 3 or 5% down. And these are not FHA products. These are Fannie, Freddie conforming loans, the standard loans that everyone's sort of more familiar with, conventional loans. And so these lower down payments are readily available. I think in New York City, there's the co-op overlay. So people get used to that 20% down requirement, and it's sort of programmed into them a little bit. Whereas the actual reality is, if it's a house or a condominium, and that loan amount, now there is a break point that you get into, which is Fannie Mae has 2 limits. The first limit is currently $548,250, so that's what we call true conforming. Then they have a high cost area limit, which in places like all of New York City, we can go up to $822,375. So it's a secondary limit. The products are slightly different, but you can do 10% down on both of them.
Yeah, that's where my clients had been running into trouble, was the jumbo loan. And, just to reiterate what you said, condos and, anything real property, you could put 10% down. A co-op, what John was saying, the minimum is typically 20%, if not higher. But yeah, the jumbo loan is where I ran into some issues last year with certain buyers that were looking for 10% on a purchase that was around 1.5 million. And that's another thing is like Manhattan, the average apartment is over 2 million. And in Brooklyn, it's, I think, 1.8 million right now. So I guess a lot of my clients are looking for jumbo loans. So is that more difficult right now? Or?
It's more difficult because of who the investor is. On a jumbo loan, in most cases, the investor is ultimately the bank itself. It's a lot of portfolio lending. So the bank is going to hold that risk in many cases. The difference with Fannie and Freddie is that the bank is not going to specifically hold the risk. So Fannie and Freddie design their guidelines. They say to the lenders that sell to them, here's our 10% down product. Here's what it looks like. You have to get mortgage insurance to go along with it. But if you meet these criteria, if your borrower meets these criteria, we will purchase those loans. And what that allows the lenders to do is to say, okay, as long as we follow this, we have a guaranteed home for this loan. With jumbo loans, the bank is holding that risk themselves, and it takes on a different meaning because if there's a default on the loan, the bank is going to directly take the loss. What this has resulted in, especially during the pandemic, is that the 10% product, I think in general, 10% down with jumbos has become less available. I don't hear about it as often. And so it is, whenever you're getting above that Fannie Mae limit, that $822,375, it's now a little trickier. 10% down is going to be something that may or may not be available.
Yeah. And it's funny. I kind of cut off my own question. I started with the misconception question and then asked you another one. But yeah, I'm always curious, like when people first talk to you and, you're the first person, anytime I get a new buyer, I send them to you first, or, they should talk to any mortgage broker that they're working with first before seeing apartments, or homes. But yeah, what are the things that when somebody first talks to you, are there things that people always seem to have a misconception about, or they're always on the wrong page about something?
I think there are a few common misperceptions. One of them is around down payments, as you just mentioned. Some people just don't realize that they don't have to have a 20% down payment. Other people are more in the other direction. They don't realize that they need to have some level of down payment or more than what they might have. Someone might come looking for a jumbo loan with a very minimal down payment. That would be more of kind of a first-time home buyer specialty kind of product. But probably the biggest misperceptions I see initially come around credit. Credit, for example, something as basic as credit scores, right? If you have Credit Karma, you have probably some kind of credit monitoring. A lot of credit cards have some kind of credit monitoring. They give you your credit score. Everybody likes that. It's very comforting. It's like your grade in school.
Right.
Oh, I got an 800.
But they don't always paint the whole picture.
Right.
Those things, right.
Right. And one of the most confusing things about credit is that there are multiple scoring models. And this is something almost no consumers know. There's FICO. There are different versions of FICO, and there are also just completely different non-FICO scoring models. And most of the time, when a consumer is getting their own score, it's not the same exact version that a mortgage. So when a mortgage lender is pulling your credit, they're specifically getting something out. Yeah, I would just call it the mortgage score, quote unquote. And what it is it's the specific scoring models that Fannie and Freddie use. So the lenders, since the industry is based around them initially, those are the scores. So you could literally walk into the same bank, apply for a mortgage, and apply for a credit card on the same day. I wouldn't recommend that because you're going to confuse both sides. You don't want to have two credit applications going at once like that. But let's say you did. The credit card division and the mortgage division would very likely tell you two different credit scores because on the mortgage side, they're pulling the mortgage score. On the credit card side, they're pulling a different version. They're pulling what their credit card risk team wants to see. And so there are these multiple scores out there that we're really not even aware of. We're just seeing this one score. Monitoring your own credit scores can be useful because you can see a change. So, for example, let's say you're looking at your own credit score and, you see 820 and suddenly it drops to 800. Then a change has occurred, and that's something to pay attention to. But just because on a given day you see an 820 on your app or something, that doesn't mean that you're going to necessarily get that score when a mortgage lender.
And what about the score? Like, is the score itself, I remember hearing years ago, like, oh yeah, you need a 720. Like that's right. Like there's rumors or there's things like, I don't know where that came from. But yeah.
Yeah, it's good to have rules of thumb, because this is where there's a lot of complexity around mortgage scores. When you look at different products, if you think of it as a risk-based analysis, the more risk in a deal, the higher the credit score needs to be, just generally speaking. So, for example, if you're buying an investment property, that's going to have a higher minimum credit score than a primary residence,
right?
Because there's more risk there. It's perceived to be more risk. If you're trying to do 10% down instead of 30% down, and you don't have such a good credit score, that lower credit score is going to start coming into play there. So it does matter. It's hard to say, because there are so many lenders and so many different mortgage programs. There's really no, I would never want to say to someone, well, your credit score must be this, because there are homes and products, to accommodate a variety of credit scores. But best practice, always keep your credit score as high as you possibly can. And there are some ways to do that are simple. I think I'll give you another misperception, or maybe just an unknown, which is that credit utilization can affect your credit scores on an immediate sort of, let's say, monthly basis. So, I might pull someone's credit and I say, wow, this $12,000 credit card balance is actually bringing your scores down a bit, because the limit is only $15,000. So you're utilizing a very large percentage of the credit available here. And they might say, well, I just paid that off. That's the the most frequent thing. And that makes sense, because a lot of times we're looking at the last reported. So frequently they did just pay that off. The problem is that that's what's on the credit, and that's the score we have to work with. So at that moment, if they could have talked to me a couple of months ago, I would have said something like, well, where are your balances? You might want to, keep your balances, don't let your balances shoot up. But at that point, now we've got the credit report. Now we have to live with what's there.
Yeah, and that's something, I always advise people talk to a mortgage professional first. And then in addition to that, there was a story when I first went to purchase my own home, and I knew this was 2010, and I knew I needed my tax return, so I wasn't going to purchase until 2011. So it was almost a year before, but I actually reached out to you because I knew you back at the time, and you did a pre-approval for me way in advance. And you said, hey, you don't have any credit cards. And I was like, what are you talking about? And I called Amex because I had a card with them for 10 years. I had a $12,000 limit. And they said, oh, yeah, it's a business credit card, and that doesn't often report to your personal credit. I mean, unless you default, then of course it's going to report to your credit. But so it looked like I didn't have credit cards. I had just canceled one. So I spent that time, since I knew I wasn't going to purchase for almost another year. I got another credit card or two. And, that makes me think of something else. Like, is it a thing, or aren't you supposed to have several active lines of credit? Like rather than have one credit card, like I've heard that you should have at least 3 active lines of credit. That's what looks good for a mortgage application. Is that a thing? That
is a thing. When someone only has one credit card, or one trade line, as we would refer to it, we call that thin credit. So there's not a lot there. Think of it almost as a resume. There's not a lot there for a person, an underwriter, to look at. Also, a lot of mortgage underwriting, initially, at least reading the credit report, there's an automated piece. So there's a part, Fannie Mae has this thing called Desktop Underwriter, which actually reads credit, and it will score the loan based on a number of factors: income, assets, debt to income ratio. But one of the primary elements it's using is the credit score and the amount of credit that's there. So generally speaking, it's always going to be better to have a longer credit history and to have a number of sources of credit. Also makes your credit score more stable. If you only have one credit card and you go late on that, it's going to have a much greater impact if you have a whole bunch of credit cards and you have a late payment there. Not that I'm recommending having a whole bunch of credit cards, but it's certainly, having one credit card is definitely thin credit, and it doesn't exclude someone from a mortgage, but it can make obtaining the mortgage more difficult. They might have to show some other things in order to rebuild, to show that they have credit in other areas. There are some new things coming out now too, where people are able to, I believe one of the upcoming things is going to be that people will be able to report their rent to credit. So that would be, because right now, the way the system's been built, if you have, let's say you're an existing homeowner, you've got a mortgage on your credit report that really helps your credit. But let's say you're going to be a first-time home buyer, you've been renting for years. Traditionally, that rent has not reported anywhere on your credit. So you're making a housing payment, but you're not building credit through it. And I think there are some changes coming that might be allowing rental history to benefit someone's credit report. I think that would be a game changer for a lot of people.
Yeah, and I don't know if you have any other list of misconception items, but I know, you mentioned down payment, and from my experience, people don't know anything about closing costs before they talk to one of us. And that's something I used to always, if somebody met with another broker, especially, a lot of times they don't talk about it, or they've just handed them some sheet like in a pile of documents. But that's something I always like to bring up, especially since condos and co-ops have such a vastly different structure. I mean, obviously, if you're financing, because the big ticket items are mortgage tax and title insurance, which don't really exist on a co-op. But yeah, that's one of the big misconceptions for me, is that people don't realize that it's not only a down payment, but there's closing costs, which could be thousands and thousands of dollars that they're not expecting. So,
right. Yeah, that is a misperception. Some people, when I'm talking to someone for the first time, I'm always happy if they've got some idea of those costs, because I hate to be the bearer of, the mortgage tax,
right.
1.9%, mansion tax. But many people are not aware. And so, on an initial conversation, I'm usually going to make sure that they're aware, because we could be talking about a $200,000 down payment, might be 20%, but we could also be talking about $35,000 to $40,000 in closing costs. Yeah,
and that's another reason a lot of people come in with misconceptions about co-ops, like a first-time buyer saying, "I don't want a co-op." And I'm like, well, why? Do you know why you don't want a co-op? Because, when the closing costs on a condo are like $25,000, and then you look at the co-op and they're like $7,000. That's something to consider too. So, but anything else with the misconception thing, or should we move on? Or?
I think another big thing is around credit checks. So I think that people, they read, people are more educated than ever, in my opinion, and they will reach out and they're afraid to have their credit pulled. It's almost like they don't want to even look at it once, because they've heard this guidance that credit checks hurt your credit. Right. And the credit bureaus, they don't say specifically, how many credit checks, or what's too much, right? They're not saying that. So I think that people who are really concerned about protecting their credit, sometimes it almost puts them into like an analysis paralysis. It prevents them from doing what they need to do, because what they need to do is they need to get pre-approved. If they really want to get out there and look at properties, they need to get pre-approved. They also need to know what is on their credit, and they need a mortgage professional to look at it and tell them if there's anything problematic on there. I mean, in your case, let's say let's say we hadn't pulled your credit so far in advance, and let's say now you found a property you love and you're trying to get it, and I pull your credit and I say, Scott, there's nothing there. That would have been a problem at that moment. Whereas because you were so far in front of it, you were able to rectify that situation. And there are things that can come up, even just small differences in credit score, that if somebody started well in advance, they would have had the information, so they could have either fixed the credit, they could have made some adjustments that would have helped them qualify. But when you are now trying to obtain the property that of your dreams that you just walked into, and you're like, I got to have this place, that's not the best time to have that first credit check done. I think so I think that's the most common misperception is like, oh, I can't have anybody check my credit, it's going to go down. One credit check, it's not going to drop your scores. Again, the credit bureaus don't tell us, right? So does checking your credit once go from an 800 to a 798? I don't know if anyone knows the answer to that. What the credit bureaus do say is that you can shop for a period of up to 2 weeks for a mortgage, and it won't affect your score. So in other words, if a couple of lenders are pulling your credit within a specific time frame, that your scores will not be affected by that. So I always try to tell people, getting the pre-approval is much more important than worrying about, one credit check. Yeah,
I was always told never to even take a buyer out without a pre-approval, unless they were buying cash. But I think the overall thing is just having a mortgage consultant like yourself pull their credit and run it, because you're the one that's going to be, facilitating the mortgage. It's going to be an underwriter. You know what they're looking for, rather than going on some free credit reporting website and looking at it yourself, because you're not really able to analyze it the same way.
Right.
So yeah, what about, different types of mortgages? Because I feel like, most people, whether they're already working with a mortgage consultant or not, a lot of people just go right for the 30-year fixed, but there's so many other products. I have a 10-1 ARM, which, you did my refinance as well. What about different products? And does it seem like most people just go for the 30-year, or they're not made aware of that there's other options?
A large number of people do just go for a fixed mortgage. They don't want the uncertainty. I think most people, most consumers have at least some understanding if they're adjustable rate mortgages, but they don't usually understand exactly how they work.
And also, is it, right, because the whole idea of a 30-year mortgage was more of an old school idea for, let's say you're in the suburbs, you're buying a home, that's just going to be your house forever, right? So 30 years it's paid off, you retire, you're living in your, right? But it's different in a place like New York City where you may be moving in 5 to 7 years, right? So it's a little bit different. And some people like myself, I did a 10-1 ARM because I don't see a family with 2 kids, living in this 2-bedroom for the next 10 years. And in refinancing, it's actually another 2 years, 12 years, because I refinanced after the first 2. So
right. Yeah. So ARM products are a good option for a case exactly like what you just described for yourself. There's if you have certainty that you're going to be selling a property within X number of years, really a 30-year mortgage in that case becomes just an insurance policy. It's like just in case I still have this mortgage. So an ARM can be a great option for the right person. The major thing to understand about an ARM is the reset feature. So an ARM is going to adjust at the end of a fixed period into an index plus a margin. And so that means that there is a market reset and there's some uncertainty there. If that index that it's based on, right now they use something called SOFR, SOFR, that's the index. If that index is much higher, meaning if the broader market has higher interest rates in the future than what you had when you took out that loan, the reset can be significantly higher than what you have. So for the wrong type of consumer who didn't truly understand that reset feature and what their payment could go to if they weren't prepared for that, or if they took an ARM, I would say the classic situation where you don't want to take an ARM is where you're like, well, the 30-year fixed payment's just going to be a little too high. I can't really afford that. I think to me, that would be a red flag. An ARM should be more of a choice to say, well, I would like to save more money. I would like to use more of my disposable income for something else because I'm certain that either this mortgage will be paid off by the time the ARM resets, which is ARMs are either usually 5, 7, or 10 years. So a 5-year ARM will reset in 5 years, 7-year ARM, 7 years, and so on. So I think that for someone who has a clear understanding and the ability to make the 30-year fixed payment, I think that's the kind of person that is appropriate for an ARM. I think someone who is saying, well, I really need that lower payment just so I can afford this, I don't think, to me, that's a red flag for
Cool.
Yeah.
Right. Yeah, that's great. So, what about where do you think? I mean, I know this is kind of a question that you may not be able to answer, but where do you see interest rates going? Because I know from my experience, like all of a sudden they're just up, right? Like all of a sudden the interest rates just move, and you don't always have warning. So.
Right. Well, that question is the $1 million question, and most people ask it the way you ask it. I know you probably can't answer this, but it's impossible not to ask. It's one of those things. It's like the stock market. It's like, well, what do you think is going to happen? Everyone's got an opinion. And so it is a very common question. I usually explain the factors that affect rates because nobody can predict rates, of course. But there are some factors that definitely and consistently affect rates, and there are a couple of things that I think consumers don't necessarily understand about mortgage rates. For what probably the most important thing is that the Fed does not directly control mortgage rates. The Fed controls short-term rates that are set on that do directly affect certain products. So, for example, when the Fed raises or lowers rates, that directly impacts credit card rates. It directly impacts home equity credit line rates. They move so the prime rate moves, and that affects those products. But it does not affect the rate that's being offered today for a 30-year fixed mortgage. Those rates are more affected by the long-term bond market, in particular by the main marker that we follow is the 10-year Treasury, and it's not an exact marker because what they call MBS or mortgage-backed securities, they also have prices that can change independently of the 10-year Treasury. But the 10-year Treasury is generally the marker that's being looked at, and that's a long-term index. What affects that particular rate, the 10-year Treasury, is what's going to happen in the future. What are the expectations? So when you see mortgage rates move, generally it is because the expectation of what's going to happen. It's not because the Fed raised rates. So if you see that mortgage rates went up an eighth or a quarter from a couple of weeks ago, what changed? It's not a rate that the Fed specifically moved. It's often what the Fed might have said. So most recently, the Fed was talking about tapering, which means that they are going to cut back on their bond purchases. Bond purchases push rates down. If the Fed starts selling a lot of the bonds that it's been buying, a lot of the mortgage bonds and government bonds, the perception is that the prices of those bonds might go down and rates might go up. So it's always the expectation of the future that's driving mortgage. If you have very strong economic news or high inflation news, that will also cause rates to go up. And that was also a factor recently that moved rates upward, was this expectation about inflation. There's been some very high inflation numbers coming out in September. And that is creating concern. Will long-term rates have to rise as a result of inflation? So I think that it's important for consumers to understand what's driving it so that they aren't too confused. For example, the Fed could come out tomorrow and raise the prime rate by a quarter point. That might not raise mortgage rates at all if it was expected. If it was unexpected, if the Fed did something unexpected, then yes, mortgage rates will react to that. But when the Fed is projecting out into the future what it's going to do, unless it changes that projection, long-term rates are usually not affected by that news.
Oh, yeah, that's so interesting. And I wonder if that goes back to what we were saying earlier, how I got such a good rate when the coronavirus was still a thing in China and it wasn't really. Did that have to do with any expectations?
There was economic weakness that was playing into it at that point. The 10-year, now there was an interesting sort of disconnect over the summer, going back to kind of what I alluded to at the beginning, where because there was fear in the financial markets, even though the 10-year treasury actually was below 1%, the 10-year treasury today is at about 1.5, 1.5. But, in the height of the pandemic, a year ago, a little more than a year ago, the 10-year treasury, it was well below 1%. The mortgage rates really didn't chase it down because there was a perception of systemic risk, and systemic risk is always going to create fear in the markets. And so the 10-year treasury it disconnected from mortgage rates a little bit. So what we saw last summer was that rates actually didn't get that much better.
Well, actually, they bumped up, didn't they, at a point?
At one point they did, yeah.
Because I remember even telling buyers, oh, yeah, you can probably get this. And then all of a sudden it was higher, but then after that it went lower. Right.
And that's why we're seeing such great rates this year, because there is a perception of economic stability. There is economic stability. The banks are healthy. The financial system's healthy. And so they're able to lend. If there's perceived risk in the system, then lending is going to slow down and rates are going to go up.
Right. So yeah, I mean, it seems like the biggest story of mortgages is just the rates. I mean, everybody should take advantage of the rates when they can. So is that it for common misconceptions?
I think so. I could go on, but it would get boring.
So I have a question for me. Whatever happened to mortgage brokers? Because this is, when we first met, you were a mortgage broker, right? And then obviously I know that when the financial crisis happened, the banks they were extremely tight and they wanted control. And I assume that that's really, they were controlling the whole process. There were no mortgage brokers then. But I've heard people here and there say, oh yeah, I have a mortgage broker. So what's the story behind that?
Yeah, so to start at the beginning of the story, before the financial crisis, there was a variety of mortgage lending operations, and it really all breaks down into I'll put it into three categories. There's retail, which is where you're going directly to the lender. You're walking into your bank, or you're directly contacting some lender, but usually I'll call that a larger lender. There's also something called correspondent lending, which is where you're working with a smaller lender who is going to place your loan with a larger lender. So you might be working with ABC Mortgage. You say, well, where do they get all their capital? Well, what they do is they fund your loan and they immediately sell it to a larger bank who buys it. And that recapitalizes them and allows them to keep lending. So those are correspondent lenders. And correspondent lenders were very, very common. They're referred to usually as non-bank lenders because they're not a big bank like where you'd have your checking account. And oftentimes they're just in the mortgage business. So they frequently will be traditionally before the crisis they were smaller lenders that would just focus on mortgage. They would sell to larger banks. And that was a very active market. And then there was wholesale, which is what you're referring to, which is a mortgage broker. A mortgage broker could be anything from a mom and pop up to a company with hundreds or thousands of employees. That's the wholesale side of the business where the mortgage broker is not the lender. They are just arranging the financing. And I would probably say mortgage brokers got hit the hardest throughout the financial crisis because many lending institutions closed up and only offered retail and correspondent. They didn't want to deal with mortgage brokers anymore. There was just too much risk. There were too many points of failure that had been identified in the system. And so many large banks said, we're only going to lend directly to our customers through our retail channel. And then some of them continued with correspondent lending. As the crisis has abated, and the mortgage business has become more robust again. The industry there are more mortgage brokers again. That side of the business has definitely come back. And correspondent lending has come back. Correspondent lending, I think, now you see some pretty large non-bank lenders out there. You see some pretty large lending institutions where they are actually the bank, but they're not a bank where you'd have your checking account. I think that consumers should explore a variety of options. There are situations. One of the primary reasons why you have so many lending institutions is because you have different types of borrower needs. You have different types of loan requests. And one bank might be interested in taking on a certain type of credit risk and another isn't. So in those situations, a broker type arrangement might be useful to a consumer, especially if they've got something that's way out of the standard credit box.
Right. All right, so I think that's it about mortgages. Let's talk about something more fun. What about, I like to ask guests, I mean, you're my first guest ever, but I'm going to like to ask guests about just, being somebody who lives in New York City, like what do you love about New York City, or what do you want people to know, like a tourist who doesn't, all they know is Times Square, like, I don't know, any fun stories?
Well, for me, one of my favorite things in New York is the accessibility to one of my favorite games, tennis. So I have a group of friends that I play tennis with. We sort of mix and match week by week. And one of the great things in New York, in Manhattan, where I am, is there are so many options to play tennis, and they're all extremely reasonably priced or
are
free.
They like outdoor options, or are they those things with the big, like fluffy domes on the top? Or?
Well, both. They have the fluffy domes in the winter. So you can, for example, if you go to Midtown Tennis on 28th, that allows, you can play in January when it's freezing.
Yeah, that's the one on the west side. I used to do comedy at the Upright Citizens Brigade Theater, and it's right over there.
Right around the corner, yeah. So in the winter, we're there, but in the summer, you have some fantastic options, especially on the Upper West Side where I am. My favorite is the Central Park Tennis House. They have 24 clay courts and some hard courts. You get a pass for $100 at the beginning of the year, and it's free. So you book online, you show up with your friends, and you can play tennis. We frequently try to play doubles if we can. You can actually play for 2 hours if you have 4 people. So funny thing, we're sort of used to playing with each other. So we had this newcomer who was joining. We needed a fourth one day. One of our friends dropped out. So she said, I'll bring my friend Alex. So we all get together, and no idea what anyone's level of play is, when they're new, of course. So we start playing, and Alex her form is incredible. Like she just she hits the ball so well. It was amazing. And her serve was just like a bullet. It was incredible. So
I'm like horrible at tennis, by the way. I've tried many times.
Yeah. And I've played a lot off and on throughout my life, but I certainly have not had formal lessons. I've never played on a team or anything. So my skills are okay. But she is just out there, and she's really just killing us. She's placing the ball.
So she's on the other team, right?
Yeah. Well, we were mixing around. So, we mixed each side. So I got to play with her 1 out of 3 times, which was great. Every time you were with her, it seemed like her team won. But yeah, it was incredible. So on the break, I said, have you, it seems like you've been playing a long time. She's like, well, when the pandemic started, I moved back to Rome. She's from Italy. Turned out there is a tennis center about 3 blocks from where she was staying with her family in Rome. And she was playing tennis. She said she took lessons every day for the entire pandemic.
Oh, wow.
So I said that explains it. That explains how you're so good, because her play was phenomenal. So
I love how so many people switched gears with the pandemic and picked up new things and became amazing at them. And
yeah, she said before the pandemic, she really wasn't that great at tennis. And now she's
awesome.
She's fantastic.
So they just kept it going they weren't afraid of, touching a ball and then serving it and receiving a COVID ball, or I don't know.
Yeah, she said she played throughout the whole thing, which was interesting because we heard about some pretty severe lockdowns over there. So I was surprised, but she said she took lessons
Yeah, there's so many different people, all with different comfort levels, and I mean, even now, everyone I know is vaccinated, and there's still people that don't want to meet in close quarters, which I understand. I mean, I always like to respect everybody's comfort level.
Right.
I'm trusting the vaccine, so we'll see. But yeah, I think, and I maybe I'll just ask this. I don't know if you have an answer for it, but do you have a favorite burger in Manhattan?
I don't have a favorite burger. I have a favorite pizza.
Oh, okay. Yeah.
Mama's Too.
Mama's Too. I don't even know that one.
Yeah, this one is up at Broadway in about 105th, 106th.
That's why I don't know that one.
Yeah.
That's another thing. I mean, about, pizza or burgers or anything like that. It's so neighborhood specific. Before I moved to Williamsburg, I always loved, Joe's Pizza at Carmine's. Of course, they have one here in Brooklyn now. But when I moved to Williamsburg, like a little over 10 years ago, there's a place on Graham Avenue called Carmine's Pizza, and it's amazing. It's one of my favorite places, but I wouldn't know it existed. That's another thing. So, you're up in Harlem. Everybody has their own neighborhood place, which nobody else knows about. So when people are so, forward in saying what the best pizza in the city is and they swear by it, I don't think you've tried, there's so many different, some pizza. I mean, I'm from Long Island, where I think, the bar was raised before I even moved to the city, because I'm not saying it's better. I'm just saying that there's so many places out here to choose from. It's hard to find the good ones, because there's definitely a lot more just generic ones than there are really great, places.
It is, yeah. And I never would have thought Mama's Too, because it's a thick pizza. And, I'm originally from the New Haven area, so I love that thin crust New Haven style pizza. But this is a thicker crust pizza, and it's awesome.
There's a New Haven style? I didn't even know. I thought it was just like New York or Chicago, right? I didn't know. Are there other styles?
New Haven. It's huge. We'll have to go there sometime to get thin crust. There's quite a pizza culture in New Haven.
All right. Well, there'll probably have to be a different reason. I don't know if I'm going to travel there just for.
It's pretty good.
All right, that's awesome. All right. Well, thanks for being on the podcast. It's been a great conversation, and yeah, if anyone needs a mortgage, you know who to reach out to. And yeah, let's end it there.
Thanks for having me, Scott.
Yeah. Okay, that wraps up this episode of the L Train podcast. I'm Scott Rubin, licensed associate real estate broker with Compass. All views expressed in this podcast are my own. I've been selling real estate in Manhattan and Brooklyn since January 25th, 2005. And if you or anyone you know are looking to buy a home, sell a home, or are a landlord looking to rent out their home, please contact me. Thank you so much for listening, and hope to talk to you soon.